Hey everyone, Eddie Wilson here, the founder and CEO of Think Realty. We're really excited for a guest we have on today. As you know, I'm not typically the host here. We usually have Avi Golhar, but today I get to stand in for Avi, mainly because we have an amazing guest for you. But before we get into that guest and before I introduce him, let me tell you about the sponsor that makes this show possible. This podcast is brought to you by Real Property Management, the largest residential property management franchise in North America. They manage tens of thousands of properties for individuals, investors, and institutions throughout the country. And you can learn more at realpropertymanagement.com. That's realpropertymanagement.com. Or go and call them at 888-806-7088. That's 888-806-7088. Great company. Couldn't recommend them more. They are doing a great job. RPM is a fantastic organization. And if you're looking for a property manager, please call them and thank them again for their sponsorship of this show. I'm so excited about our guest today. I had the chance to meet him and sit by him at an event last year. And I have had the chance to meet and speak and interview many economists around the country. He is specifically unique because he says things that most economists typically don't say. And I love that about him. I love his candor, his openness, and his grasp on the economy. And so today we have the distinct pleasure and opportunity to interview Doug Duncan, who is the chief economist for Fannie Mae. A phenomenal mind who understands not only the economic situation of our country, but how it impacts the individual American, the citizen. And I think that's what makes him singularly unique in our space. So I want to first of all thank Doug for coming on. Doug, welcome to the show. Thank you so much for gracing us with your presence. We are so excited to have you today.
Well, thanks, and thanks for all those kind words. I might try to live up to all that. And you obviously haven't talked to my mother, who would give you the truth. But
can we call her in? Can we get his mom on the phone? Okay.
Yeah, try to make something out of him. That'll be her perspective.
That's awesome. That's awesome. Well, let's just jump in. I mean, obviously, this is more of a conversational, topic. But every investor that we speak to, which our network of investors, are obviously very concerned about where the economy is, where it's going, what choices they've made. They're seeing anomalies in our space, such as a reduction in interest rate just recently. And so, just 30,000-foot view, what do you see in our economy? What's going on right now? Where do you see us heading? And, give us any anecdotal thoughts that you have, and then we can jump into some of the other things that you guys provided for the show.
Well, right now, the economy's performing pretty well. It's interesting that the Fed cut rates, and there were two of the Fed governors that dissented from that, thinking that the economy is doing pretty well and they didn't need to cut rates. It's not very often that there are two dissents at any of the Fed meetings. But the dissents were essentially, we need to let monetary policy work for a little while because the economy is growing at about its capability. And its capability, if you add the growth of the population plus the growth of productivity, that's a way that economists tend to think about how fast can the economy grow without inflation. We're about at that growth rate, a little bit over 2.25% this year, which is about where that number should be. So that's the question then is, why is the Fed doing what they're doing? Why have rates fallen, which recently they've fallen pretty precipitously? It is global factors. And while it's rare for the central bank over the history of the U.S. to cite global factors as concerns because they're more focused on how monetary policy affects the United States, being the U.S. central bank, that has come into the picture, and I think it will remain in the picture for a while. This is because we've probably seen the peak of trade liberalization, which has been taking place over the last 40 years, and all the discussions of tariffs and currency differentials is probably going to be part of the discussion for a while. That's got markets very concerned. Interest rates recently have fallen. I think yesterday they got as low as, the 10-year got as low as 1.6%, which means mortgage rates are coming down, not that fast, but the people are jumping in, and this is an opportunity to refinance. If you've taken a mortgage between 2016 and today, there's a reasonably good chance you could refinance and improve your financial position. So that's the underlying driver. The housing market, if you think just about housing and home sales, the appreciation that we've seen in house prices over the last 5 or 6 years are largely a function of the fact that boomers are not moving. So the typical entry-level house for a first-time home buyer, which is an existing home from somebody who owns it and is selling and then moving up to another, boomers are aging in place, and actually the Gen Xers are pretty much staying in place as well, which has limited entry-level supply, so prices have appreciated very strongly there. And the activity has slowed down over the last 2 years, even though interest rates are still in very good condition. So what does that mean going forward? If we were to have a mild recession, housing would probably do okay.
Sure.
Because that supply shortage would hold it up, and the interest rates wouldn't go up in a recession. So housing would probably do okay.
Yeah, it's interesting. Obviously, the Federal Reserve, as a countermeasure to inflation, increases, decreases the interest rate. But for all intensive purposes, inflation's been fairly flat. So it's interesting to me that they would decrease, because after being a period of of fairly flat inflation, it seems like they would have to increase or at least hold steady. So I don't know. It just doesn't make sense to me. I understand what you're saying, and I understand that it's a global issue that they're dealing with. But it just still doesn't make sense. Could you shed any light on that?
Well, for one thing, the Fed has for many years been believers in the Phillips Curve, and Phillips was an economist that suggested, if you look at the data in the period that he looked at it, that there was a trade-off between unemployment and inflation. So if unemployment fell below a certain level, you'd expect to see a pickup in inflation. And if you're going to tamp down inflation, you would slow unemployment. Well, that hasn't worked for 30 years. In the last couple of decades, the Fed has a target of seeing 2% inflation, and they've rarely seen inflation rise to that level. My personal view is I think the Phillips curve is a correlation. It's not a causal relationship, and I think they've been mistaken to focus on that issue. What's different today, and why rates are actually falling, and why inflation has stayed below their target level, is that we've gone through this long period of trade liberalization, which has opened global labor markets to compete. It's one of the reasons that there's concern in the U.S. about jobs moving elsewhere. That trade liberalization has opened competition to lots of countries which are less developed than us, for example, and therefore labor costs can be lower than ours. So all of those global factors have been having an impact. Today, there's a discussion in the policy arena of trying to make changes in trade relationships that would benefit U.S. workers. That's the intent of this discussion. And that has raised concerns in the business community, particularly those who have any export component to their profit-making strategies, that those tariffs are actually going to reduce their opportunity, and therefore it's led to weakness in business investment because of the rise of uncertainty about whether or not those markets are going to exist and if they're going to be profitable.
Sure.
So business fixed investment has fallen as a result of that, and that's one of the reasons the Fed is concerned the way they are. You bring up so many other questions, but I'll kind of try to stay on topic here. You have recently done a poll on consumer sentiment, and I know that someone from the Fannie Mae sent that over a couple of days ago for us to see. So, obviously, you must have some insight on how consumer sentiment is going to play out in the near future, and you've seen some anomalies there as well. So, could you speak towards that survey that you did, and what does that survey mean? Sure. We survey 1,000 households a month. We call it the National Housing Survey because it focuses primarily, though not exclusively, on what does all this mean for housing. We've been doing this since June of 2010. Consumer sentiment is very strong. People feel good about their job, that feel pretty secure in it. They expect their incomes to grow. And you're actually seeing that in the data. It's consumer spending today that's holding up economic activity. The consumer is very strong in the second quarter in terms of consumption. The good news is their savings rate is also quite high.
Sure.
So they're in pretty good shape. If there's a downturn in the not too distant future, consumers are actually in pretty good shape. They've been controlling their debt. Other than student debt, that's the one area that is of some risk. And there's been a little bit of a rise in delinquencies in dealer-provided credits on the auto front. But other than that, things look pretty good. So that's one of the reasons we think that if there were a slowdown, it would be fairly mild at this point. The dark cloud in all of this is that the level of annual deficits, which get added together and create our outstanding debt, is rising strongly and faster than economic growth. In the long run, that's just not sustainable.
Sure.
And now that probably won't come to the fore in the next recession, but the one after that could be a lot more problematic if we don't get control of that.
It's interesting. I was looking at that graph and kind of moving, back and forth today, looking at it. And on that graph, it showed that we're at the highest level of consumer sentiment that you've ever seen in the polling process. And so is there a correlation with that sentiment with, not that I want to talk, about politics or anything like that, but is there a sentiment change when we come into a heavy electoral cycle? Like when we get into the election, will you see sentiment drop or raise or drop because of, the election?
It tends to, the sentiment numbers tend to become more volatile as we close in on an election. I would not expect that to happen until mid-year next year. But if you look at the last two presidential election cycles, the volatility of those data spike during the election. Interestingly, there is potentially some predictive capability there. So if the headline question that we ask in the survey, after we screen for people that are decision maker in the household, so it's like the likely voter survey.
Sure.
Are you a likely voter?
Yes, sir.
So we are you a decision maker in the household? Because we want to talk to people that are driving the economic activity in that household. So we ask, is the economy on the right track or the wrong track? And it spiked. The volatility around that spikes in the months close to the presidential elections. In the 2012 election, both right track and wrong track spiked pretty similarly. In the 2016 election, those who thought wrong track spiked a lot more than those who thought it was right track.
That's interesting.
So, and you saw the result in the election, which was really an upset.
Sure.
So we've seen a little bit of divergence recently of those thinking we're on the wrong track. We think that might be related to the tariffs and the trade discussions.
Sure.
But generally speaking, consumers feel very good about their position, irrespective of politics. Right at the moment, they feel strong about their employment, their income growth. Question is, does that translate to housing? Well, there needs to be a house to buy, right? At the entry level, there just isn't the supply, very low levels of supply. And again, first-time buyers typically don't buy brand new homes.
Sure.
They buy existing homes, fix them up, and then eventually as their family grows, they sell those and buy a new house. That's more how the housing ladder works. So right now, the only thing that's holding them back is availability of supply.
And, you look at, obviously we have a ton of investors on the Think Realty platform, and they're trying to come up with all new models, the build-to-rent model. They're trying everything. But the sentiment among our community is that until the baby boomers really start to let go of the properties that they currently occupy, that we're going to have a supply issue. That obviously we can't. We're struggling with affordability to build that lower, entry level house, and so the only way to service that inventory is to find it in the existing housing, community. So, I mean, do you feel the same way?
I do. It's for investors in residential single-family homes. It's been a really good market, and I think it will continue for a while. So you have two opportunities there combined to give you the return you're looking for. One is that rent appreciation will probably continue for some time, and capital gains will as well. The value of those properties will remain strong.
Sure.
So though you add those two things together, there's your return on your investment. So particularly at the lower price levels, that will continue to be the case. As the price level moves up, what you've seen is that institutional investors, not the moms and pops, but the institutional investors, have sort of segmented themselves into three different buckets of rent ranges. And a lot of that depends on where they are geographically, which one of those buckets that they're in. But for the peak of the first-time buyers in the younger cohort, typically called the millennials, although that's a little bit of a misnomer, but typically that's not going to peak for another 6 to 8 years. So there's a good run to come here.
That's awesome. You also sent over a survey on how consumers are shopping for home loans. I looked at some recent data by Adam Data and also CoreLogic that showed the massive spike in people looking for home loans through technology portals, things like that. What are you seeing in regards to that? I mean, you obviously have this survey and how consumers are shopping for the loans. Is that going to have an impact on our economy or the housing stock?
Yeah, actually, I think what it's doing is it's making more educated consumers who are likely, therefore, to be lower risk, which means in a downturn, the magnitude of the downturn is going to be less severe. Particularly young households who are first-time buyers are committing a smaller share of their total income to housing than would have been the case, say, in 15 or 20 years ago. That's good news, because it means they'll be more resilient if their income is curtailed in a downturn. They'll be more resilient and be able to sustain their house. That's all good news. The second thing is a higher share of them are shopping. Something our survey showed, something like 3/4 of them talk to more than one, or 2/3 of them talk to more than one lender. That's actually a good thing, both for the lenders and the consumers. If you shop two lenders, that means a second lender got a shot at that business. So there's more opportunity for a shot at the business. And the data show clearly that those who do shop multiple lenders get a better deal at the end of the day than they would have gotten if they only talked to one lender. It's common sense, but competition only works for you if you activate it. So there is evidence in the survey of the folks that only talk to one lender trying to negotiate with that lender and getting less movement on the terms than those who had talked to more than one lender. Second thing that was really interesting to me was that a higher share of folks who are buying a home lock in the mortgage before they sign a contract on the house. That's actually a behavioral change, and I think it's been enabled by technology allowing for gathering more information than in the past was available. So I think that too is a good thing on the part of consumers.
Yeah, that's really interesting. Last year we saw a modification to Dodd-Frank. I spent a lot of time with Senator Crapo's office and others and real estate investors, on the Hill. It seemed like it was going to open up some additional lending opportunities because of that modification. Have you seen any major national changes or anything come from that modification? Or, are you seeing anything change because of that?
Not that we can tie directly to that as a causal factor. the lack of supply is probably affecting a whole range
Sure.
of things. Were there more supply available, you might see more of a response to that,
Sure.
to those changes.
Yeah, it's like, it still seems like there's more capital that can ever be expended that's in the marketplace, especially as an investor. I mean, there is more capital chasing deals today than there are deals to take advantage of the capital. And so we're just, in our space, we're just waiting on that supply, and trying to find it in any other pocket we can find it in. Another survey that you sent over was this mortgage lender survey. What is that survey, and then how do you perceive that survey to impact the consumer?
So we started our consumer survey back in June of 2010. After a couple of years of monthly surveys, we started asking the question, well, I wonder if there's a mismatch between the expectations and perceptions of consumers relative to lenders. Are they kind of talking past each other in some way? If you remember Archie Bunker on a television, he used to say, "We're two sheep passing in the night." So we were wanting to see, is there a mismatch? And in fact, we discovered there were some mismatches. If you ask consumers what they wanted from technology, they wanted the ability to shop information.
Yeah.
If you ask lenders what they wanted from technology, they wanted operational efficiency.
Mm-hmm.
And so telling the lenders, look, this is what consumers are looking for. If you want to get access to the consumer in a more effective manner, you're going to need to think about Apple being your competitor,
Sure,
as opposed to the lender next door, because that's the experience that
right.
younger households have. I can call up anything I want on my iPhone. So that has actually shifted, and the most recent data that we see is that that lenders are absolutely focusing on the consumer interface. That's their number one thing now, is to talk directly to the consumer in an efficient technology space.
Mm-hmm.
So we did the second survey, which I'm not sure if our comms folks shared with you, which asked, is there a threat to traditional lenders from big tech? So are they worried that Amazon could come
Sure.
in, or that Google could come in and actually take away some of that business? So the lenders are concerned about that, but it's still kind of a secondary concern to the other lenders that are next door.
Sure.
And maybe the more technologically efficient. So we ask consumers, what do you think about that? And we ask them, do you trust your bank? Do you like your bank? Would you recommend it to other people? Would you go to somebody like big tech as a source to get your mortgage? Well, interesting, on the bank side, they said, well, we trust them, but we wouldn't recommend them to our friends and family. So we said, well, what does that mean? It means they don't think that the bank is going to lose their money.
Sure.
But they're not happy with the consumer friendliness of the services.
Level of service or whatever. Yeah.
Yeah, and if you're in the mortgage industry, one of the really interesting things is we asked of the different kinds of activities in your financial life, which of these would you be happy doing electronically and not need to talk to somebody, and which ones would you like to talk to a person? Things like making deposits at the bank or extracting cash, all of that heavily electronic, don't need to talk to anybody. 79% of people said, when I get a mortgage, I want to talk to a person. So if you're a loan officer, at some point they're going to want to talk to you. So buying a house, big transaction, going to move your family, going to want to know something emotionally attached to that. Put your paycheck in the bank, big deal.
They want to put eyes on somebody, talk to somebody, because it drives that level of comfort. That's really interesting. Yeah. I've seen, if you look at the national mortgage surveys on originations, you're seeing that technology is winning today. I mean, the people like Rocket Mortgage and the big people that are out there, marketing heavy and serving, the consumers heavily through technology seem to have the greatest increase. And then you see the biggest banks who have the technology seem to be winning out too, and so So, I was looking at originations between J.P. Morgan Chase and Wells Fargo, and it seems like the ones that are technology focused are the ones that are leading the way in originations, which makes sense. But it's interesting that that with those, you can also walk into a bank and talk to someone as well. So you've got the comfort of the physical presence if you need it behind the technology. Yeah, that's interesting.
That's right.
That's interesting. So I've got a question for you, and this is the one this is my left field question. Are you ready? So I have heard you say on numerous occasions things that no other economist will say. And so my question is, what are you willing to say today that a traditional economist might not be willing to talk about in regards to our current or future economy? Is there anything that you see on the horizon that may be outside of what the PR teams of the traditional economist are saying? Look, don't say that. We got to give the listener and viewer something. So are you willing to put anything out there that might be a little bit counter theory to a traditional conversation with an economist?
Well, I hinted to it a little while ago when I talked about the monetary policy and the Fed's target of 2% inflation as being an optimal level of inflation. I think it's been that they have failed to achieve that for such a long time period that I think there needs to be a fundamental rethinking of macroeconomic activity. And I'm not talking here about modern monetary theory, which you may have heard about in the political headlines. You can't actually find a theory behind that. It's just, let's spend more and it's not a problem. But in terms of the actual conduct of monetary policy, I think it needs a fundamental rethinking. And I especially given that we're moving to what I think is we have passed the peak of trade liberalization, and there's the fundamental direction of trade relationships is going to be sustainably different. The reason I say that is the rise of China is different than, for example, what we saw with Japan in the 1980s. The rise of China, they have much broader intentions than Japan had about their global role. And what's going on in trade with China is much more than just trade. It's also intellectual property. It's also freedom of global shipping lanes and global input chains. I'll give you an example. One of my coworkers had a 2012 Audi A6, and in that, if you looked at the back bumper, you saw these little nodules which is where backup cameras. But in that model, there were no backup cameras because of the tsunami and the nuclear event in Japan, because that's where those cameras were made, and during that time period, they weren't produced. So that global supply chain was interrupted, which led to a change in a product that was delivered in the United States. So this is a much broader issue, and to this point, most of what economists have talked about is just the trade relationship and whether that's going to lead to inflation in the U.S. or larger numbers of imports and exports. But it's actually a much larger picture than that. If you involve a global shipping security, geopolitical risks from a regional perspective, intellectual property, all of those things, I don't think this ends if there's a change in who's president in the next political election. I think this goes on for quite some time.
That's really interesting. I was just down in Panama a couple of weeks ago and looking at the new development there from the Chinese and developing almost a secondary canal there in Panama. And it almost seems as if they're gearing up a forced separation from us, which, like you said, could really lead to a causal, effect on what we're doing from an economic standpoint. But
absolutely.
The other thing too, and I know we're coming up on time here, but our HB1 visas and all these immigrant visas, we're not increasing the amount of people coming into our economy that are skilled labor, and so that's staying fairly flat. And obviously, we've got all kinds of issues, politically when it comes to people coming in and out of our country. But it is interesting to me that we have this issue with trade today. But we're not counterbalancing it by bringing skilled labor into our country to ultimately counter-effect, what's being done there. Any comments there?
Yeah, absolutely. There are both political and economic considerations. This is a nation of immigrants. Mm-hmm. That's well acknowledged. It's also a nation whose immigration policy has been assimilative, meaning we invite people to come, we make them citizens and assimilate them into the national culture while retaining elements of their historical culture. So you get all kinds of great celebrations of different kinds of festivals and things like that. But we're Americans. That's different than what you get in many European countries where they are guest workers.
Right.
But we're also a country of a rule of law. And so the interface that you see is this question: if we're applying the rule of law in other areas, why do we not also apply the rule of law where immigration is concerned? Mm-hmm. That to me is the point of focus. Now, our birth rate of domestic population is not replacement. Mm-hmm. In other words, in absence of immigration, our population will actually start to shrink, which is the case in Italy, it's the case in Japan, it's the case in Russia. These are places that are not particularly friendly to and have an immigration model, in some cases at all. They don't allow immigration at all. And in some cases, if they allow it, it's not assimilative. So in the absence of immigration, our population will shrink. If you're in housing, that's not a good story, and I don't know of a market where that would be a good story. So we actually need to act on that. With the current level of immigration, we're just at replacement of our population. And to your point, the nature of the immigrant population matters because, and that's another flashpoint, it's currently focused toward family. So if it's about bringing relatives who are not going to be in the workforce, then that becomes a social burden from the perspective of providing a social safety network, and that's part of the flashpoint. If we're bringing in people with skills, that actually augments the productivity of the workforce, and that increases our expected future economic growth. Those are all the fault lines in that space, and it is really important that we have a national conversation because much of the future growth potential of the United States and various sectors of the economy depend on rationalizing our immigration policies.
Yeah, I've read probably the recent statistics just like you have, that in order to sustain our own growth, we need to have 2.3 children or whatever, and our current rate of reproduction is like 1.6 or 1.8. I mean, we're just pacing way behind. So your point is well taken. Doug, it's always a great time having a conversation with you. I thank you so much for coming on and being a part of our network and helping our real estate investors and those in this community understand our economy better. Thank you for being candid and open. And any last words, any place that they can follow you? I mean, I don't know if you're active on social media or anything like that, but how can they follow along with the great Doug Duncan?
Well, I asked my 17-year-old daughter, I said, what do I need to know about Snapchat? She said, forget it, you'll never understand it. So I'm not on Snapchat. There's some stuff on LinkedIn and a little bit of Twitter, but I'm more, I like to get out and meet people and talk to them directly because I always learn things from what people ask me, things I haven't thought about or maybe haven't thought about thoroughly. So I travel a lot. We do put up on the Fannie Mae website our forecasts and various research that we do, the things that you cited, the surveys, all of that's available free up on the website. And I do get people that call and ask, what do you think about this aspect? I love that because that means two things. One is people are listening, and second, they're thinking. and it helps me figure out what we haven't thought about as we're doing that work. So, there's various social media things and stuff out there as well.
Awesome. Yeah, and we'll make sure to post links to all these surveys that we talked about today when we put this program out. So again, thank you so much. I really appreciate your time today. For the Think Realty listeners, thank you so much. This segment's been brought to you by Narada Real Estate Investments, your premier source for cash flow investment properties. Visit turnkeyrealestateinvestments.com. That's turnkeyrealestateinvestments.com. Go talk to my friend Marco Santarelli there, and he can help you with turnkey assets. Thank you guys so much. I hope you enjoyed the time with Doug Duncan. I appreciate you listening and following along. And with any questions or thoughts, follow us on social media and engage with us. Thanks and have a great day.